What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be doing some stock analysis for United Health stock. This is ticker UNH. This is another stock that I should have bought more of after it dropped last year because now the stock is up 10% today to $309 a share when last year, roughly, what is this, almost a year ago, about a year ago, the stock went from $600 all the way down to $275, which is just insane. And the reason for that explained here is due to a combination of rising healthcare costs, disappointing earnings, and growing regulatory pressure. So, and this is relevant to what we're about to talk about, which is the biggest driver is the explosion in the medical care ratio, meaning the percentage of premiums that is spent on patient care rather than profit. So they just weren't as profitable because more money was going out. And that number rose from 82% in 2022 to 89%, which doesn't really seem like that big of a jump. But I guess that's substantial enough to cause the stock to drop by over 50%. And that means that profits were squeezed as more money flowed out for care rather than retained for margin. This happened because the Medicare Advantage members were using far more healthcare services, right? Then we have the earnings missed and the cut to forecast, lowered its profit outlook. Okay, reported earnings of 720. They missed a slight miss. The company admitted it underestimated care utilization and misjudged reimbursement rates. Okay, the Centers for Medicare and Medicaid Services proposed only a 0.09% payment increase, which is basically nothing, for next year's Medicare Advantage plans, which effectively acts as a cut after inflation. This combined with fears of shrinking membership, projected loss of 2 to 3 million members, which is a lot for this year, and slowing reimbursement growth drove investor pessimism. After years of stable growth, the dual hit from earnings and policy uncertainty caused their multiple to go from 25 to 12, just insane. But as we see here today, the stock surges on improved 2027 Medicare Advantage payment rate. So what's happening now is that number, that payment rate is going to 2.4%, which is substantially higher than the preliminary 0.09 figure announced a couple months ago. The rate adjustment will deliver an extra $13 billion of federal payments to health insurers in the coming year. So that's a pretty big deal. And again, that's why I wish I would have bought more when this stock was around $250. I just bought one share because I was really interested to see how this stock was going to recover basically and how long it would take. To be honest, I thought it was gonna. I'm kind of surprised it took this long. I mean, it still hasn't recovered really. I mean, it went up to 367, which it looked like it was on a good streak there, but really, look at the past 5 years. I mean, this stock was typically around $500 a share, and we're still nowhere near that. So I think the stock will recover. I guess it's going to take, 2 years from when it bottomed basically to get back to that mark, but I thought it would recover honestly in like a 6 month span or something. So either way, I just have one share now just to because I want to keep an eye on it. But it would have been nice if I bought more shares. If we come over here to Qualtrim, we can see this is now a $281 billion company. The PE is still pretty cheap, 17 times this year's earnings, 5.7% free cash flow yield. That's good. I wouldn't say it's amazing, but it's definitely not bad. Price to sales of 0.6. That's super cheap. I mean, $447 billion of revenue for the past 12 months is crazy. Net income is not looking good. As you can see, these last couple of quarters, it's come down quite a bit. They definitely don't have any growth going for them right now. If we look at it, let's look at a quarter by quarter basis. Yeah, see, they just hit $10 million for the quarter. That's bad. So it's been trending in the wrong direction. Their debt to cash is now pretty much the worst it's been in the last couple years. 28 billion in cash and 72 billion in debt. The dividends are slowly going up. I guess that's an okay thing. Shares outstanding, they are buying back a little bit of shares. And then let's take another look at this valuation here. So price to earnings past 5 years, we're right in the middle. So earnings basis is not too bad. Same thing with free cash flow, somewhere in the middle. And then price to sales is definitely cheaper. So that's where we are with that. Then we come over here, and I like to look at the PEG ratio. We're at a 1, which is, again, pretty much in the middle. If we're looking for future forecast here, we have a slight drop in revenue this year and then a 3% revenue growth. I mean, they're doing an insane amount of revenue, so I'm sure I don't know how much you can grow really when you're doing a $500 billion. That's what that is. But EPS 13 to 16 this year, and then 18 next year. So they have the EPS is supposed to get better, which that's nice. And that should keep the stock moving up. Then we come over here and we can see that, let's go all the way back up here. Let's go to, okay, UNH is the largest healthcare company in the world by revenue. Incredible. Operating at a massive scale to influence nearly every facet of the US healthcare system. Here's a breakdown of the business, competition, blah, blah, blah. They operate a dual engine strategy, capturing margins across the patient journey, with United Healthcare as the core insurance engine. They provide health benefit programs to employers, individuals, and government entities like Medicare and Medicaid. They make money by collecting risk-based premiums. They assume the financial risk of covering medical costs, profiting when the premiums collected exceed the medical claims paid out and administrative expenses. So just like any other insurance company, only this is the biggest one. This is the health services and technology arm, which is called Optum. This operates across three distinct subsegments. Optum Rx, which is a pharmacy benefit manager negotiating drug prices and fulfilling prescriptions. Optum Health, which directly employs physicians and operates a massive network of clinics and surgery centers. Optum Insight, which provides data analytics software and technology to hospitals and even rival insurers. Interesting, that just shows their scale. Revenue Source, Optum generates revenue through fee-based services, software subscriptions, and direct patient care. Okay, so the synergy of this model is how these two halves feed each other. United Healthcare can utilize Optum's data in clinics to lower overall care costs, while Optum can sell those same efficient services to external. I mean, they really have like the perfect business model, really. So that's why, again, I'm surprised it took this long to even get to where we're at. I thought the stock was going to be over $400 by now, really. UNH possesses a wide economic moat built on deep structural advantages that are incredibly difficult for peers to replicate. Massive scale and network economics, serving over 150 million people. So that's almost half of the United States. UNH's sheer size gives it unparalleled bargaining power. They can negotiate lower reimbursement rates with hospitals and secure heavier discounts from drug manufacturers than any small rival could achieve. And that's huge. That's a big deal. That goes for most businesses. When you're, the top dog like that, you have more bargaining power. Vertical integration by owning the insurance provider, the doctors, the data analytics, and the pharmacy benefit manager. They control the entire value chain. This allows them to effectively transition from a traditional fee-for-service model to value-based care, where doctors are paid for positive patient outcomes rather than just the volume of procedures. Their integrated services and complex technology systems are deeply embedded into the operations of large, blah, blah, blah. And then we get down to their financials. I'm always preferring GAAP numbers over non-GAAP numbers. I think it's just a safer, more conservative way. It is important to see what are those one-time costs that is the differentiator there. But still, I would pick the GAAP. Normally pick the GAAP number. So GAAP for last year was $13 a share. And a non-GAAP was 16, but again, I'm looking at the 13. The substantial gap was driven primarily by over $3 billion of costs stemming from the Change Healthcare cyber attack alongside significant restructuring. Okay, so there's a good example. So $3 billion in cost. Now, it's a one-time cost from this cyber attack, but does that mean we just should count it out and shouldn't pay attention? They spent $3 billion last year. Like, it's still something that happened that affected the business, even if it might not happen again. So I guess when you're comparing, let's say, last year's numbers to this year's numbers, it's going to look like a big jump. So let's see, what did we just look at over here? 13 and 16. So 1323 to 1679. So in other words, these are GAAP numbers, right, that Yahoo has. So it kind of looks like it's a big jump there, 13 to 16. But I mean, I don't know. I think I would prefer that. So in other words, if they had the non-GAAP number of, I would prefer the GAAP number still because it looks like, so in other words, it's going to look like it's higher growth because of that one time, that big $3 billion cost that hit them. But still, I would rather, from that perspective, maybe non-GAAP is better. If you want to look year over year from how much are they growing. But if you just want to know how much money they made and how you're going to value the business, I still want to look at GAAP. Management has issued a cautious but steady forecast for this year, targeting over 439 billion in revenue. What did they do the last 12 months? 439 billion, 447. So it is expected to come down. Keep that in mind. Non-GAAP of 1775. So non-GAAP for this year, 1775 and 1670. And again, so slight different numbers there. Analysts generally forecast a long-term growth rate of around 12%. Wow, that's more than maybe for EPS, as the company works past structural headwinds. However, near-term growth is pressured by anticipated membership declines in Medicare Advantage, shrinkage of now 1.3 to 1.4 million members, which is what they brought up last year. Only remember they said 2 to 3 million. Now it's half of that. And tightened Medicaid margins. Because of these factors, it is viewed as a foundational year of focus. Okay, so I guess that could be what's keeping the stock price down. But really, maybe so after this year's over, it's probably going to go back up because the business is not going to stay like that. So even at this, I don't know, possibly at this price, it's still not a bad buy. Again, I think you really have to pay attention to the valuation here. Price to sales is cheap, right? This is the last this is the look at the last 10 years. This is the cheapest you're going to get it. Normally it's trading at about a 1.2, and so it's normally trading at double this price to sales. Free cash flow yield is in the middle, and then same thing with price to earnings, right? So from that standpoint, it's not a great buy at this price. So I don't know if I would buy more here. I would say, maybe under $300, maybe, maybe 280 or so, it would be a good buy. But I don't know. At the same time, if those numbers come back strong, like I said, I still see the stock getting back to $400. So I think even if 2026 is kind of weak, I think 2027 and beyond, those numbers are going to improve with margins and everything. And then the stock should be over $400 again. So that is my analysis for United Health. Let me know what you guys think down below, and I will see you in the next video.